Imagine an invisible tax. It doesn't appear on your statement, yet it silently consumes your savings year after year, guaranteeing that the people managing your money get rich, regardless of whether you do. For decades, this invisible theft was simply the cost of doing business on Wall Street. These conflicts of interest cost IRA investors alone between $95 and $189 billion over a single 10-year period, a crushing amount of wealth siphoned away. But one man, an investor, an economist, and an outcast, built a ship designed to sail directly against the entire financial tide. He was John Bogle, the founder of Vanguard, and his simple common-sense approach did more for individual investors than any figure in modern history. Warren Buffett, the undisputed sage of Omaha, put it simply, "Jack did more for American investors as a whole than any individual I've known." To understand the revolution Bogle started, we must first look back at the investment world before 1975. This was an era dominated entirely by active management. The consensus was simple. You paid a lot of money for a star manager who would use superior research and intellect to beat the market. The system was built on the premise that finding the needle in the haystack was achievable and worth the enormous cost. Yet, the dirty secret academics had known since the 1930s was that most professional forecasters could not consistently outperform the market average after accounting for costs. The underlying issue was not just poor skill, but structural conflict. Traditional mutual funds were owned by an outside advisory firm. The directors of the fund, often selected by that same advisory firm, were tasked with approving the fees the fund paid to the advisor. This created a system where the advisor was incentivized to charge the highest possible fee, while the client wished to pay the lowest. The industry subsidized this inefficiency through high fixed commission rates, enabling complex practices and layers of fees designed only to justify the price. This institutionalized structure was designed to maximize advisor profit at the expense of client returns. The system subsidized its complexity through practices like give-ups and reciprocal practices, where commissions were recaptured by managers to reward brokers for selling fund shares. The investor was trapped in a golden cage of complexity and high costs. John Bogle's path was paved by this exact kind of financial devastation. Born in 1929, his family lost nearly everything in the Great Crash, a life event that profoundly instilled in him a commitment to prudence and caution. His uncle paid for him to attend Blair Academy after his family lost most of their wealth. From a young age, he was fascinated by mathematics and computations, a skill he later applied rigorously to the mutual fund industry. The blueprint for his revolution was laid down years before he ever founded a company. While studying economics at Princeton University, Bogle spent his junior and senior years writing a 130-page senior thesis titled "The Economic Role of the Investment Company." This detailed analysis established his deep, early understanding of the mutual fund industry's structural issues. The thesis was so compelling that the founder of Wellington Fund, Walter Morgan, hired Bogle based on its strength in 1951. Bogle rose quickly at Wellington Management, eventually being acknowledged as the heir and becoming chairman. But his radical ideas for diversifying the firm clashed with the traditional strategy of focusing on a single fund. In 1974, a poorly conceived merger decision led to his swift dismissal. This professional catastrophe was, in hindsight, the most important failure of his career. Had he remained, he would have been permanently constrained by Wellington's existing, profit-driven corporate structure, hindering the full execution of his radical vision. His firing was the only way he could establish a company built from the ground up to embody his non-profit client-first philosophy. In 1975, Bogle founded the Vanguard Group. The name itself, Vanguard, signifies the leading element of an advancing movement. The mission was explicit: to take a stand for all investors, to treat them fairly, and give them the best chance for investment success. The company was founded on the idea that they needed to think beyond profits and do right by everyday investors. Bogle knew that philosophy was useless without an enforceable structure. His innovation wasn't a product, it was a constitutional change. Vanguard is unique because it is mutually owned. The Vanguard Group Management Company is owned by the very mutual funds it manages, and those funds, in turn, are owned by their shareholders, the clients. This fundamental structure ensured that Vanguard's focus would be long-term client success, rather than short-term quarterly results, because there are no external shareholders to satisfy. This structural moat completely eliminated the inherent conflict of interest that plagued Wall Street. Because Vanguard is client-owned, it charges only enough management fees to cover its operating costs, with no profit margin added on. This simple alignment of interests is the reason the Vanguard effect could last. It permanently shifted the priority from the advisor's income to the investor's final return. The second pillar of the revolution was the investment strategy itself, index investing. The concept was simple, yet radical. Instead of paying a manager to try to beat the market, a statistically improbable feat after fees, the fund would simply buy every stock in a selected index, like the S&P 500, and hold it. This approach, known as passive investing, minimizes turnover and reduces the transaction costs that actively managed funds incur. This commitment to broad diversification is best summarized by Bogle's famous advice: don't look for the needle in the haystack, just buy the haystack. This idea was built on rigorous academic research. Researchers, particularly by the mid-1970s, documented that active investment managers were failing to add value to the performance of passive benchmarks. The growth of professional investment management had not translated into better results for investors. The academic community provided the theoretical framework for Bogle's approach, showing that comparable market indices consistently outperformed actively managed investment funds over time. In 1976, Bogle launched his radical experiment, the first index investment trust, the precursor to the Vanguard 500 index fund, marking the first index fund marketed to retail investors. The investment industry responded with immediate, furious derision. Wall Street analysts labeled it Bogle's folly, ridiculing it as un-American and a sure path to mediocrity. This was more than a business critique. It was an ideological conflict. Indexing implied that professional, highly paid active managers were structurally incapable of consistent outperformance after fees. The launch was a commercial disaster, attracting only $11.3 million, 95% short of its target. Bogle realized that the slow start was a function of fighting entrenched industry belief and cultural bias, not product failure. He stood firm, demonstrating that the only way to win the Wall Street game was not to play by its rules. Bogle's success was fueled by his core principles, a common-sense creed that shifted investing from a competitive sport into a patient, low-maintenance chore. He preached investment over speculation and reducing broker fees as much as possible. His philosophy emphasized the importance of simplicity, discipline, and avoiding market timing. He famously advised investors that the hardest part of investing is sticking to a consistent strategy, noting, "The enemy of a good plan is the dream of a perfect plan." Bogle codified his wisdom into practical rules, often referred to by his followers as the Boglehead Creed. The first rule is minimize costs. Fees are the one reliable anchor on returns, meaning investors should select low-cost funds. The second is patience. Avoid trying to time or speculate in the market, advising that time is your friend, impulse is your enemy. The third rule is diversify. Avoid chasing individual stocks encapsulated by his advice. Don't look for the needle in the haystack, just buy the haystack. Finally, simplicity. Stick to a few broad, consistent investments because the enemy of a good plan is the dream of a perfect plan. The long-term impact of this philosophy is measurable in billions. Index funds inherently keep costs low because they use a buy-and-hold approach, resulting in lower transaction costs and reduced turnover compared to actively managed funds. This commitment means Vanguard's expense ratios are now approximately 80% lower than the industry average. This might seem like a fraction of a percentage point, but over a lifetime, compounding costs can dramatically reduce an investor's nest egg. Bogle understood that this structural refusal to seek profit would be Vanguard's competitive strength, its permanent competitive moat. The profound difference is stark when comparing the pre-Bogle era to the environment Vanguard created. Before 1975, active management featured high average expense ratios, often 1.5% to 2.5% plus commissions, with the manager's goal being to beat the market and maximize advisory fees. The structure was for-profit and shareholder-owned. Contrast this with the post-1976 Vanguard Index Fund. The average expense ratio is drastically low, often below 0.1%. The goal is to match the market and minimize investor costs, and the structure is mutually owned or client-owned. Critically, Vanguard's benchmark cost is now approximately 80% lower than the industry average. This phenomenon became known as the Vanguard effect. Vanguard's existence created structural deflation in the financial services industry, forcing industry-wide downward pressure on fund fees. As investors flocked to lower-cost index options, competing for profit firms, including Invesco and Federated Hermes, were forced to slash their own expense ratios simply to remain viable. This competition effectively transferred hundreds of billions of dollars annually from the financial industry's profit margins and back into the pockets of everyday investors. This is structural competition based on moral philosophy rather than product differentiation, representing one of the greatest acts of consumer empowerment in modern financial history. Bogle's message resonated so deeply that it sparked a massive grassroots movement. Followers of his simple tenets, known as Bogleheads, formed online communities dedicated to disciplined, long-term, low-cost investing, emphasizing broad diversification and financial simplicity. He created not just a product, but a system and a philosophy focused on ethical structure and disciplined investor behavior, proving that investment success was defined by adherence to a few basic principles. Today, Vanguard is a dominant force in investment management, alongside BlackRock and State Street. Together, these entities are known as the Big Three, index fund managers that play a dominant role in retail investing. The immense success of indexing is undeniable, but at a global scale, Bogle's solution introduces new, complex challenges. This enormous concentration of passive ownership, while financially efficient for the investor, poses new systemic questions, particularly concerning corporate governance. Index funds are passive, aimed only at matching market performance, not outperforming it. Critics argue that these funds lack the traditional financial incentive to engage in costly activism or ensure that individual companies and their portfolios are well run. Since index funds seek only to match performance, any investment in improving a specific company benefits all index funds equally, while only the activist fund incurs the costs. This creates a profound collective action problem, potentially leading to a vacuum of corporate accountability. Crucially, the revolutionary himself recognized the dangers of this colossal success. In the years before his death, John Bogle repeatedly sounded a public warning about the concentration of corporate voting power. He worried that if the trend continued, the Big Three might own 30% or more of the U.S. stock market, representing effective control. Bogle stated explicitly that he did not believe that such concentration would serve the national interest. Bogle's later concerns highlight a profound nuance. Every revolutionary solution, when scaled globally, introduces new, complex side effects. Analysts also point to risks like market crowding, where investors pile into the same stocks, fragility, and challenges to price discovery. The concern that if too many investors blindly follow the index, the true price of individual stocks may be distorted. John Bogle died in 2019 at the age of 89. He lived modestly and practiced what he preached, investing almost exclusively in Vanguard index funds, often following a simple 60% equities and 40% bonds allocation. His legacy is the democratization of wealth building. By defining investing through simplicity, common sense, and cost reduction, he fundamentally changed investing from a high-stakes, confusing competition into a patient, low-cost commitment, delivering true value to the individual investor. Bogle taught us that the hardest part of investing isn't finding the next great stock, it's controlling your own behavior, minimizing costs, and staying the course. If you want to master the discipline of long-term wealth creation and continue exploring the forces that shape our financial world, subscribe now. And tell us in the comments, what is the most important lesson you learned from John Bogle's philosophy? See you in the next video.